Joining us now is Raymond James Chief Investment Strategist, Jeff Saut. Jeff, it's good to see you.
Pleasure.
Thanks so much for joining us. What do you think the impact is of this decline in the price of oil?
There seems to be a pretty tight R-squared or correlation between the decline in the price of oil and weak stocks. I don't quite understand it, but that appears to be the R-squared over the past few months.
Well, energy earnings, obviously, a big portion of the S&P earnings, and that's why earnings were down overall because of energy. But, you know, when you look broader at the commodities complex and how things have slowed down so much and collapsed in terms of commodities, steel, iron ore, copper, all this stuff, because of the weakness in China, is that a reason to avoid stocks going into the
I don't think so. And I would say what's going on in China is a compositional change in their economy. While the slowdown in their purchase of those kind of iron ore and steel and commodities in general, if you look at the other side, they're switching to domestic demand. If you look at iPhone sales, they're up 80% year over year. If you look at Nike sales, it's up over 30%. If you look at the importation of higher quality foods, it's up 26%. So they're actually creating domestic demand, which I think is a good thing overall for China.
And then there's the Federal Reserve, John.
Jeff, we have interest rates potentially going up, and we're also seeing right now a beating going on in the junk bond market, and I wonder what you make of that and whether that also is a sign that stocks might be turning over. In the past, we've tended to see stocks going the way junk bonds have gone, and junk bonds are really not doing well this year.
Yeah, it's been a disconnect, but I think a lot of the high yield complex has to do with the bankruptcies that are going to come from the good rich petroleums of the world and the energy complex. I mean, I spent 3 hours. You know Ron Barron. I spent 3 hours with Ron Barron and his energy team yesterday up at the GM building, and you know they think the carnage is not over yet in the junk bond.
But is that contained just to the energy complex, or are we seeing this broadening as something that's going to affect the whole stock market?
I don't think so. I think the real carnage is in the energy complex. I think if you actually take the energy earnings out of the S&P 500, which you can't really do, but if you do, earnings aren't all that bad in the overall aggregate.
Looking at those master limited partnerships, do you worry about individual investors who have reached for yield in energy stocks and MLPs and how it's almost like a replay of 2008 with the bank stocks? How much devastation has happened there?
Well, I think that the business model for the upstream MLPs is broken. They need to fortify their balance sheets, and I don't know anybody that's going to do a deal for them because they bagged everybody. But the midstreams, as Warren Buffett says, they're like the toll collectors. The energy has to come through the pipes and the storage area, and the midstreams have been sucked down with the upstreams, which have price sensitivity to energy prices. The midstreams don't have much price sensitivity to the price of crude oil. So I actually think buying the midstreams here between now and year end and tax loss selling is going to be a winning strategy.
Even if you've lost a ton of money in them, you would put more money on them?
I haven't lost a ton of money.
Not you, but if somebody else had rode them all the way down.
Well, the problem with this business, and I've been in the business 45 years this month, is that people refuse to manage the risk. In The Intelligent Investor, which Warren Buffett says is the best book ever written on investing, the whole concept is captured in the quote that the essence of portfolio management is the management of risks, not the management of returns. So people, you know, think something's going to come, Enron, it's going to come back, it's going to come back, it's going to come back. The biggest mistake people make is not managing risk in this business and limiting the downside.
Seeing a negative and then sort of managing it. Let me ask you, the Federal Reserve is meeting in 2 weeks, December 16th. Are you expecting the Fed to raise interest rates, and what does your 2016 predictions look like?
I think the Fed is going to raise rates. I think the economy is stronger than the surface figures suggest. We were at Avra last night. It's, you know, the best Greek restaurant in the city.
I love that restaurant.
Yeah, it was packed. And I travel all over the world. We just got back from 2.5 weeks in Tuscany, and I mean, there's no recession.
You're living a life, 45 years in the business. You deserve it.
Jeff, what's the market going to do when the Fed does raise rates? Is this one of those cases where once it happens, people go out and buy again, or is it going to?
I think the Fed raising rates is a positive sign that they think the economy has gained enough traction, and we actually think the GDP is going to accelerate to 3%.
So the market rallies after December 16th. Is that what you're saying?
That's what I think, yeah.
And 2016, where do you want to allocate capital?
I like just about all the sectors. Technology looks very cheap to me. The two sectors I really don't like are staples and utilities. A lot of portfolio managers that I've seen this week haven't believed the rally that we've been in, and so they've tried to hang out in healthcare, in utilities, and in staples. And staples look pretty expensive to me.
Are you at all worried? We're 7 years into this expansion. Are you at all worried that it's getting a little old and is going to lose some steam in the next year?
I have seen this play before, and secular bull markets tend to last 14 to 15 years. They compound at about 16% per year. We're almost 7 years into this. If past this prelude, we have another 6, 7, 8 years left.
Unless she increases interest rates into a global slowdown, which is what we talk about all the time on this program because of the industrial complex possibly already being in recession. Is she going to raise rates just as we are seeing the global slowdown accelerate?
She is going to raise rates, but we've had lunch with Janet, and I think she's going to be true to her word. I think she raises rates in December, and then I think she waits 3 or 4 months to see the impact on the economy, on the real estate market, and on the various equity markets and bond markets before she takes another rate hike.
Because
so,
she did
tell you at lunch?
Well, it was us and 80 other people. It wasn't just Janet Yellen.
Okay.
I mean, she did suggest that she could raise interest rates and then cut them later.
Well, so I mean, you talk about raising rates into a global slowdown. That tells me that the dollar is getting stronger, and so how do you play that? How do you play this strong dollar trade?
I actually think the dollar peaked on the last week on the announcement by the ECB and Mario Draghi. And I think that the Paris tragedies gives Mario Draghi huge cover to do more quantitative easing, and Europe looks undervalued.
So you want to buy Europe?
Yeah.
Jeff, good to see you.
It's a pleasure.
Thank you so much. Jeff Saut, Raymond James, Chief Market Strategist there. Coming up.